All right, so I wanted to talk about my favorite kind of trade, which is selling puts for earnings. So here is an example. You could see Nike here. Look at the day that the trade was open. So December 20th at 3:37 p.m. So about 15 minutes left to closing time. I sold a 140 put on Nike expiring December 23rd, collected $1. And then the next morning, so December 21st, as you can see here, 9:32, so 2 minutes into the market open, this trade was closed for 3 cents. So a quick $97, 97 gross profit in not even a few minutes in the market. So this is definitely my favorite kind of trade. Now, obviously, it doesn't always go that well. Now, the stock was trading at 156, and I went with the strike that pays $1. I went with the 140 put. By selling the 140 put, I basically, all I need is for the stock to stay above 140 by expiry, and I keep that premium. So I still have a range where I can still win. That range is from 156, where the stock was trading at, from 156 to 140. So Nike can drop 16 points and I could still make that $1 profit. And in terms of percentage, I mean, Nike can drop 16 divided by 156. It can drop 10%. Nike can drop 10% after earnings and it could still make that profit. Now, 10% isn't impossible, but it's unlikely, but everything is possible. Instead, I got lucky. The stock ended up shooting up after earnings. It went to 167. So therefore, the put option that I sold for $1 was definitely worthless. As you can see, it was worth three cents the next day. Now, what's the risk? So the risk is if the stock drops below 140, which is possible, but I went into the trade knowing that I can handle it. If the stock drops to 140, 135, 130, I would end up rolling the put. So I would just buy back the put and then sell the same strike for a higher credit, resulting in a net credit until the stock recovers. So what matters is to pick a stock that you think eventually goes up or over the long run goes up. I also noticed PE ratio is 43. It's a stock that pays a dividend. I mean, it's a great brand. So it had a 52-week high of where's the 52-week high of 179. It was trading at 160, 156, and I had a strike of 140. It had a 52-week low of 125. So all these factors made me confident in selling the 140. You could see that the 52-week low is 125. If you look at the chart, I mean, there's probably a low here of 145 in the past 6 months. But if it breaks this 145, it can probably drop all the way down to 133. So 133 is pretty bad, but I could still handle it by rolling the 140 put. But for Nike to reach 133, that means that it would have to drop about 156 divided by 133. It would have to drop, 133 divided by 156. It would have to drop about 15%, which is kind of unlikely. And if I look at, if I look up the stats on earnings stats, let's see what Nike has done in the past. So let's just look up Nike here. I think they provide stats on Nike. Yeah, there it is. There's Nike. So I'm gonna look up actual versus expected. Click on go here, and I'm gonna look at this chart here, this chart over here. So you could see that most of the time Nike goes up after earnings. So the gray area is the expected move before earnings, and then the color lines is the actual movement. So you can see that most of the time it does stay within the gray zone. Sometimes it has gone outside of the gray area. On the top side, it has gone outside of the gray area maybe more times than it has gone outside of the gray area on the downside. So it has gone above expected move on the top side more often than it has gone outside of expected move on the downside. So you can see if you look at when did the green line surpass the gray area. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. 17 times out of how many earnings? I think it's about like 70 or 90 earnings, 90 incidents. And then on the downside, we've got 1, 2, 3, 4, 5, 6, 7. So definitely not as much. And let's see what the worst case scenario was. So it has never dropped more than 10% lower than expected move. You can see here that the biggest green zone here is 9%. The expected move was 5%, but it ended up dropping 9%. And that was back in June 2012. That was the largest move down for Nike after earnings. So having a 140 strike, which was 10% lower, based on previous stats, seemed pretty safe. Now, what do you need to sell puts? With Questrade, you need a margin account with level 4 options and minimum equity of 25,000. Now, if you don't have 25,000 in your margin, you can link your TFSA as long as your TFSA plus margin combined is more than 25,000. With interactive brokers, I think you only need $2,000. You need $2,000 of equity just to start selling puts in a margin account with interactive brokers. So how much capital does it take to place that Nike trade? So because Nike was trading at 156 and I had the 140 strike, this was the amount of capital required to place the trade. So 30% times 156 minus the difference between 156 and 40, so minus 16. So times 100 times the number of contracts. So it took about 3,000 US of capital to place this trade to make this $100 profit overnight. Now, if Nike had dropped below 140, the amount of capital required to keep rolling the trade, to keep saving the trade, would increase. So if it had dropped to 140, it would have taken about $4,200 of capital. So that's something that I make sure of before entering a trade. Can I afford rolling the trade in the unlikely scenario, in the worst case scenario? If the stock does drop way below the expected move, then can I handle rolling it? All right, so just wanted to share with you my favorite kind of trade. So if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.